Hi everyone, and welcome to today's webinar where we'll be looking at some of the updates over the housing sector over the last 18 months. Bit of housekeeping before we make a start. Hopefully you can hear me and see me. If you can't, there are some alternative means that you can log on to the session, which are on the screen. I will apologise in advance if there are any technology issues. I'm not expecting any, but you know, the joys of Wi-Fi. I am in the office, so I can't even blame home Wi-Fi today. There is the option to ask questions throughout today's session via the chat function, which is on the right-hand side. I will, if time allows, try and get through a few at the end of today's session. If not, I will respond to everyone individually. If you think of a question after the session, please also feel free to contact me. My contact details are on the screen. The session is being recorded and we will circulate a recording of the webinar along with today's slides, and it will also be available on our website as well if there is anything you want to pass on to colleagues. So what we're going to have a look at today, we're going to have a look at an overview of the last 18 months, some of the accounting challenges that the last 18 months have brought, and some of the common pitfalls we see in the compilation of financial statements. We're going to have a look at the changes to the Accounting Direction 2022. We're going to have a look at some of the audit changes that have been brought in and also look at how to prepare for the annual audit process. Touch upon some regulatory matters, have a quick look through tax, and then touch on a few things that we can see coming on the horizon. So for those of you that know me and those of you that don't, my name is Louise. I am one of the housing team at Mitchell Charlesworth, heading up the team as Paul Wainwright soon departs. I'm also head of audit for Mitchell Charlesworth, working very closely with all the RIs across the practice. Have quite a mixed portfolio, specialising in obviously housing and other not-for-profit sectors, charities and academies, also commercial companies. I also work across the practice ensuring quality and ensuring the training and development of all our staff. A little bit about Mitchell Charlesworth. For those that aren't aware, we do have 4 offices across the Northwest. Chester, Liverpool, Manchester and Widnes. And really, we strive to be more than just your accountants, giving you a real personal relationship that gives you a peace of mind, but also the building blocks for you to take on your strategy and assist with that. You'll obviously be familiar that we do specialise in social housing, but we do have other specialisms as well across quite a broad range of sectors. So, introductions done and dusted. I think we can all safely say that we probably expected the first bullet point here to be firmly on today's agenda. And I think when I started sort of collating some ideas for today's webinar, it was obviously the first thing. And then as I got into it, I actually realised that there's actually quite a lot happened over the last 18 months to 2 years. Notwithstanding COVID, and obviously COVID has had a huge impact on everything we do, both financially and operationally. But I think now we are really starting to see how Brexit's starting to impact us with the microeconomic conditions that it's brought, shortages of labour, you know, inflationary increases, struggling to find materials for project builds, etc. We've also got the National Housing Federation Code of Governance being introduced. Obviously, first came on the scene back in November 20 with the aim that it would, you know, be rewritten and restructured to adapt to the ever-changing environment and the expectations of the key stakeholders, obviously particularly the tenants. and changing the key values of that code. We've also seen the Social Housing White Paper come into force, outlining new regulations, including a strengthened housing ombudsman, new powers and reporting against new key performance indicators, particularly around resident satisfaction, income and expenditure measures, and the onus really being on the tenant. We've had quite a lot of changes, although you may not have seen it, in the audit reporting requirements, which we're going to have a look at today, some far more tangible than others. And from January 22, the new accounts direction was issued. So if we have a look first at the impact on finances of all these new measures and regulations and factors that have come in, obviously I touched upon COVID being the main source of uncertainty over the last 18 months, and that really has had quite a large impact on finances. I think it's safe to say many of us have weathered the storm far better than we had originally perceived, but that shouldn't be disregarded for not having the effort and the attention and the drive that we've all had in order to weather that storm. So we've seen issues with rent arrears and changes in the way that the controls and procedures around rent collections have been undertaken. We've seen the trade-off between rent increases and safeguarding of tenants and making sure, from a well-being point of view, tenants are well managed. Pension volatility has played quite a significant, particularly in the 21 accounts, where on 1 month, there was a valuation, and within a month or two, that valuation had greatly changed. And that pension volatility obviously then comes into the financial statements. Big impact on investment decisions, to develop, not to develop, to invest, not to invest. And I think a lot of the focus over the last 18 months has been to survive as opposed to making those investment decisions. So I anticipate over the next 18 months, we're going to see quite a big swing in that. I'm sure many of you will laugh at the next one, because I know certainly for the clients we act for, the reforecasting and budgeting has played a significant role in actually getting through the last 18 months. And those reforecastings being uncertain even 3 months to the next 3 months with all the lockdowns, openings, starting the economy. So it's been quite a difficult process to adapt to. Government support, I think going back 2 years, we probably would never anticipated the likes of furlough coming in and being around for so long, and the government investing so much back into the economy. And with that, it obviously brings financial reporting considerations as well. Property market, I think it's safe to say the property market has hit an all-time high, particularly in the Northwest. And that's again going to bring challenges probably that we will start to see now and going into the next 12 to 18 months as those investment decisions and strategy start to develop. Capitalisation of component replacements. I think the biggest challenge here has actually been in disposing of components where replacements have been implemented, but actually they haven't been separated out. So we've seen quite a few issues around actually ring fencing the original components in order to dispose of those. Obviously COVID, Brexit, everything that's been going on has really given us an insight into potential evidence of impairment, and those impairment reviews around property, stocks, debtor recoverability has been really crucial in assessing the financial reporting, but also in concluding on audit opinions. And we've seen an increase in insurance claims as well, and making sure that the reporting on those is appropriate. I think the impact on finance is obviously something that we've been very close to, but I don't think anything can take away that the most significant impact has certainly been on operations, whether that be the planned and routine maintenance delays and deferrals, whilst also maintaining stock quality, and obviously the accessibility issues that have been centred around those routine maintenance. I touched before on the macroeconomic conditions that we're now seeing as a result of Brexit and the resources that are available, increasing material prices, increasing labour prices, and that's all going to play a big part in strategy as we move forward. Resident communication, again, really, really difficult with the various lockdowns that were imposed on us by the government. And we've seen quite an agile learning process in actually adapting the systems and processes during the last 18 months. I think closely linked to that is staff welfare. I know that obviously, with working from home, people have struggled. Also, adapting to a new way of working and all the concerns around sort of health and well-being as well. The value for money priority shift, so much focus was given to value for money over the last few years that once COVID came in, was that at the forefront of everything that we were doing? Probably not as much as it should have been or could have been, because there was all these other things to consider. We've seen a real focus on tenants' needs and safety with the various new regulations that have been brought in. And again, that leads to operational shifts and transitions. And the final point there, governance, and we will have a bit of a section on governance because it's actually, for us, probably one of the biggest things where we're seeing feedback from the regulators and issues arising around governance and everything associated with that. So if we have a look at some of the accounting challenges and common pitfalls that we've seen, particularly over the last couple of years, some of these are COVID related, others are just issues that are in the sector at the moment. Obviously, that from a valuation point of view, COVID meant that ability to get expert valuations was challenging because of access, etc. But also the volatility in the market led to real issues around defined benefit schemes and complete volatility, 1 year to the next. And obviously the impact on the financial statements is quite great in those circumstances. You would have hoped that as we slowly came out of COVID, that market would have sort of stabilised. But I think we're now facing more challenges ahead of us with everything that's going on from a global economy point of view. But also a lot of the defined benefit schemes don't just rely on sort of FTSE figures, they're relying on government guilds, treasury, property market prices. So there's still a lot going on within that market now. I touched upon impairment, and I think, certainly as an auditor, impairment is something that we do have to look at each year. And when there are specific parameters that we look at, and with everything that has gone on in the economy, obviously impairment was further up the agenda than probably it had previously been, whether that be fixed assets, housing stock, debtors, any of the assets. If there was evidence of impairment, we were having to get further clarification from you, the board, around evidence of impairment, why things weren't impaired, and if they were we appropriately impairing them. I think the next one is probably one of the most common questions we're asked as auditors, and that's around provisions. Just emphasising here that they do have to be contractual as a result of past events and be reliably measured in order to be recognised within the financial statements. So what we've seen over the last 18 months, well, we've seen quite a lot of staff and restructuring and organisational considerations. and provisions made against those commitments and contractual terms. Quite often we've seen them disclosed as exceptional items so that the reader of the accounts can appreciate and understand that these aren't, regular reoccurring items, but they are exceptional to give some more substance to the financial statements. But I think the biggest one is around the planned maintenance delays and them not actually being contractual as a result of past events if the programme of maintenance just hasn't been fulfilled from an access point of view. So we're actually saying that is prohibited under the SORP, and working with clients to make alternative suggestions from a disclosure point of view. Obviously, it can lead to quite significant peaks and troughs in the results, particularly on the income and expenditure. As I've touched on, pensions, market conditions have been quite unsteady, and because we are reporting at the balance sheet date, yes, we can look from a post-balance sheet event point of view, but that valuation at the balance sheet date is the value that goes into the financial statements. So whilst we were expecting some sort of stability, we were a bit unsure as to how that will pan out as we come to the next tranche of March year ends. Onerous contracts, I think this is particularly relevant to those of you who are, undertaking developments or looking to undertake developments, and the potential losses that should be recognised up front on those if there's potentially, issues or discontinuing of those developments with all of the factors that we've touched upon or alternative ones. We've seen quite a lot of clients asking questions around bank loans and covenants, and particularly around either breach of covenants or where they've got a covenant waiver due to sort of those exceptional circumstances that we've touched upon. And also the disclosure of loans within 1 year, over 1 year, interest rates, etc. With COVID, with deferrals, the parameters of those have been moved. So we've been working with clients to ensure compliance with the disclosure requirements, whilst also giving some explanation as to what has happened during the period. And finally there you'll see government grants. Few things to consider here, as I touched upon, with everything that's happened, the government have generated new schemes, the furlough scheme, and other local authority support. And it's been important to make sure that the financial reporting on those grants is appropriate, but also from a tax perspective with the additional reporting that's required from HMRC in relation to some of those schemes. And obviously making sure that any recycled capital grants and rollover permissions are obtained via Homes England, particularly if there's been a delay in getting programmes started and finished over the period. It'll come as no surprise that going concern is probably quite high up on the agenda of key financial reporting. I think the emphasis here is always that the actual going concern assessment is the board's assessment. It's not the auditor's assessment, it's not the accountant's assessment, it is the board's assessment. And in order for the board to adequately assess the going concern assertion, there's a lot of things to consider. Availability of cash, the net current asset or liability position, the level of free reserves available, history and past results, if there's regular losses, potentially an indicator of a going concern issue. But a lot of work, I know, has gone into this final point around future plans, budgets, sensitivity analysis, testing those assumptions, reviewing those assumptions, how do they pan out? And I think actually, if we went back 2 years, we would have said, oh, that was really, really hard to predict. But I don't think that's gone away. I think what we're seeing with inflation increases around utilities, materials, labour costs, I think we're going to see, those assumptions play a big part in the budget preparation over the next 12 to 18 months still. Just emphasising here, if there are a few conditions that do sort of point to going concern issues, but there's still, quite a viable model there, you can just have disclosure. It doesn't sort of rule out that, oh my goodness, there's a going concern issue, therefore we're going to have to, qualify, etc. Adequate disclosure in the accounts. And a lot of you will have seen that, the going concern accounting policy reference in the audit report, that's been enhanced over the last 2 years to take into consideration that, there have been more factors to consider. And I'm going to come back to the impact on the audit report because we'll look at that in a bit more detail when we look at the revisions to some of the international audit standards that we have to follow. Okay, so we have seen over the last 6 weeks the new Housing Direction 2022 come into place. Effective for periods beginning on or after the 1st of January 22, but early adoption has been encouraged. And I think those who have already had a look at this will see that the changes are relatively minimal. Obviously, the last direction from 2019, compared to that, very, very few minor changes. So if we have a look at those changes, first one is looking at some of the segmental reporting and bringing in lease costs into sort of the pro forma. We've got related party disclosures, and I think the key here is the clarification of some of the definitions and new definitions of what constitutes related party disclosures, intra-group transactions, key management remuneration, directors remuneration, including pension costs. So just being aware that, there is quite a focus on that related party disclosure, as there has been over the coming years. Narrative reporting, there is another emphasis here that narrative reporting, is quite a significant part of the financial statements. And I think from a narrative reporting point of view, it will mean something slightly different to each of you, whether you're having to complete a strategic report or not, the board report, the value for money metrics, all of this narrative reporting, and those of you who are large, the carbon reporting, all of this narrative goes with this sort of viewpoint that you should each year really start with a blank page, and this is your opportunity to tell your story, celebrate the successes, give some weight behind why things may not have gone quite to plan. So the narrative reporting, whilst maybe just a refresher of what it entails, is probably something we're going to see more and more attention brought to, particularly when we're looking at the regulation side. As I touched upon, the clarification and the new definitions have been included, so definitely worth a read in that respect. But I think this, it's not overhauling the way in which the accounts are drawn up or what we're doing, but it is an opportunity to refresh, sit back, stand back, have a look at what's being done, and just ensure that full compliance is being met. Okay, so as I touched upon, there have been quite a number of audit changes over the period. I think some of that will be quite visible to you as clients, others not so much. I think COVID-19 certainly impacted the way in which we approach audits quite significantly, from looking at risk assessment and understanding what risks the sector is facing, and then integrating that into our audit approach was really critical. We obviously had a period where we couldn't always be on site, and we had to review the way in which we actually did things in gathering audit evidence remotely, getting evidence from experts, for example, property valuations. There was a lot of challenges, and we had to make sure that all of the planning to the audit work that we undertook was really well thought out in order to get not just the audit evidence that we needed, but to ensure that that audit evidence was the quality evidence to conclude appropriately on the audit opinion. Assessing judgments and estimations, I think this is quite a significant one, not just because of COVID and the sort of estimations that we used in some of the judgments there, but also when you see of the coming slides, there was a revision to the auditing standard around estimations and the work that we had to do. So, it meant that we had to think about things slightly differently, do some more work around things, and reperform those estimates, which on the background of COVID did obviously create some challenges that we were able to overcome, but not without asking more questions, obtaining more evidence, reviewing things slightly differently. Post-balance sheet events disclosure and going concern conclusions. As I mentioned when we were talking through going concern, the COVID impact and the uncertainty did impact quite a lot of entities. It's safe to say that it probably didn't affect the housing sector as significantly as A, we may have imagined, and B, as much as others, for the fact of the security, the level of reserves, and the way that the housing associations that we certainly work with adapted their operations, adapted their processes to weather that. And obviously we saw some changes in reporting deadlines, albeit not so much with the sort of regulator returns, but there was some more leniency in respect of that. As I touched upon, I think the biggest thing from our point of view was the revision to the auditing standards that we do follow. And, dare I say the word going concern again, but actually not only were we faced with, a lot more concern around going concern with the backdrop of the economic climate, but we actually then got delivered a new accounting standard, a revised accounting standard, which we had to ensure that we followed. And I think we discussed this with our clients quite early on in the process, in that it wasn't necessarily doing anything different, so to speak. We always had reviewed the going concern. We'd always asked for, the management's assessment of going concern, forecasts, etc. But I think we had to far better document our review of assumptions, our understanding of those assumptions, and to some degree the sensitivity of those assumptions for the ever-changing landscape. The most tangible change from an auditing standards point of view that you will have seen was the changes to the audit report. And notwithstanding the fact it went from sort of 3 pages to 6, 7 pages, the audit report was certainly one of the biggest changes from our perspective. There was a tweak to the going concern narrative in the audit report, giving a far more positive assessment of going concern and the conclusions thereon. But by far the biggest change was the reporting on fraud and irregularities. And if we sort of go back, 2 years, when a lot of audit firms were in the press for the wrong reasons, with the collapse of BHS, the collapse of Patisserie Valerie, the regulators sort of wanted auditors to put more ownership and more context to the outside world of what they had considered around fraud and irregularities. Now, the auditor is not there to detect it. However, our approach and our audit procedures, we would hope, would detect it if if able. So the audit report now covers 3 key headings which I've documented on this slide. So the extent to which the audit was considered capable of detecting irregularities, including fraud, identifying and assessing potential risks in relation to irregularities, and the audit response. Now, when I have sort of board meetings, closing meetings with clients, I always think it's actually a really good thing for the board to read this element of the audit report, because it does give some useful concepts and takes on what we do actually do in respect to those, particularly around laws and regulations, the control environment, and accounting estimates. So one to consider there. As I mentioned, accounting estimates, not only on the backdrop of COVID and those challenges, but again, revised auditing standards. And this required a retrospective review of management's estimations and the judgments exercised, and the concept of, some estimates are going to be very mechanical in nature. For example, accruing for late invoices, very mechanical, whereas others, assessment of bad debt provisions, may be more judgmental based on management's understanding, expectations, and the idea of looking back retrospectively on those estimates to see how reliable the management's judgment is. And in considering the accounting estimates, some of the things that we have to consider as auditors with the concept of standing back and reviewing independently is, well, where could the management bias be? How appropriate is the risk of material misstatement at varying, key risk level, whether it be income recognition, whether it be understatement of creditors? Ensuring that the audit evidence we've obtained is sufficient, but also giving us the right level of assurance that actually management's appropriateness to make those judgments is correct. And then ensuring that there's the adequate disclosure to the financial reporting framework. Again, you will have seen and will see within the judgments and uncertainties disclosure within the financial statements, that's now starting to be enhanced to bring in the perceived key estimates, whether that be the pension scheme estimates, which obviously it is slightly removed from management, through to application of bad debt provisions, etc. So you'll see that it has been a few changes for us as much as it has been for you. And I think, we've learned some really good lessons over the last few years, whether that be from the remote working that we've done, or just engaging with our clients far more throughout the year rather than just a year-end process. But what we have learned is that planning is really key, and that the sooner that we engage with our clients as part of that process, the better the audit goes. Agreeing platforms to be used, so agreeing quite early on in the process whether we're going to be on site for the whole duration, whether we're going to take a hybrid approach, or if we may even continue on the remote audit front, and agreeing early on in how data collection is going to be implemented, how we're going to engage in that process. For many of our clients, they'll have seen that we've used Inflow for client collaboration. Over the last 6 months, we've enhanced that now to start looking at the data analytics side. So there may be further requests in the audit process this year for nominal ledger uploads into Inflow, so that we can perform some data analytics on there to give a bit of added value to our clients, but also to support our audit approach and enhance the audit quality and the subjectivity around sample sizes. And I think, a lot of that is sort of collaboration, but what can you do to help the process? And I think the preparation of additional information is really, really key here, particularly in ensuring forecasts and budgets for the 12 months from the date of anticipated audit report sign-off are completed. Engaging with experts early in the process, whether that be the actuaries, any professional valuers. Communication, as I alluded to earlier, I think the key for us is certainly to not have an end of year process, to open the dialogue well before year end, so that if there are any contentious matters, we can discuss them, plan a course of action and agree on approach. And then the final point here, and I think sometimes this can almost sort of get lost in the process, is that the letter of representation, which is signed as part of the overall sign-off of the audit, is actually your letter to us. I know it may seem strange because it actually comes from us, but the letter of representation is the board's representation to us of what has happened in the year, anything we should know about, that everything has been provided to us, we've had full access and full knowledge of anything that we should know about. So part of the planning, it may be worth revisiting sort of the last year's letter of representation to assess whether there's anything that may need to be updated, changed or enhanced in respect of that letter of representation. Okay, I'm going to move on to some regulatory matters, and I think obviously the Code of Governance coming in has been one of the major changes over the last couple of years, particularly as the Statement of Compliance is expected from 2022 year ends. So for many of us, that's fast approaching. It's built around the key values of what good governance should be based on. So accountability, integrity, openness, equality, diversity and inclusion. So it's gone from many principles down to 4 core principles: mission and values, strategy and delivery, board effectiveness, and control and assurance. I think the first 2 really centre around tenant engagement, tenant satisfaction, and the second 2 are far more around the governance, both from a financial governance point of view, but from a strategic governance point of view as well. And if you actually look online, there is a really useful checklist, which I can also circulate at the end of the session as well, in Word document, of what are these principles, what is the expectation, and how do we measure against them, with option for action points, and also making sure that they're delegated to the appropriate person within the team. We are seeing increased activity from a regulatory point of view. I think certainly from a governance point of view, and I think governance is one of the key aspects that they are really picking up on at the moment. We've been in talks with regulators over the last 12 months quite a lot, and it is certainly the governance sides that they are particularly focused on. I think what their message is, and the key to all of this, is actually don't leave it too late to get the regulator involved. Cooperation and working collaboratively with the regulator is far better than letting things get too far down the line. I've highlighted some of the key messages here. You'll see from this first slide, it's around health and safety requirements, tenant liaison, tenant complaints, effective communication, very much focused around how we interact with tenants, but also the compliance aspect, and as I mentioned, this idea of co-regulation and requiring registered providers to be really transparent, engage with the regulator from early on if there are any issues arising, if they need help or guidance on regulatory issues as well. So what does good financial governance look like? And I think it's probably the million-dollar question, and it probably means something slightly different to everyone. I actually did a webinar back end of last year aimed at charities, but it was solely around governance, and I did that in conjunction with DTM Legal. And it may even be worth, you having a look at that and maybe circulating it to your boards. And this is one of the slides from there, but I thought it was very important to try and highlight what does good financial governance actually look like. And I think the key factors are listed here, clear defined roles, understanding skills and skills gaps, and almost performing a board appraisal. Effective, well thought out, planned meetings with a clear agenda, so that key items are addressed and given the priority that they need. The creation of an annual strategy and measuring against that annual strategy. And I know a lot of our clients do already have this, but the use of subcommittees, particularly finance, audit, risk, including health and safety. Financial planning, I know we've touched upon the idea that it's been quite difficult to financially plan over the last few years, from both a strategic point of view, and also the sort of getting into the actual forecasting. But obviously the board have a role to play within that process. Ensuring the adequacy of financial controls is also key. Understanding the control environment, approving changes, and taking on board recommendations, from internal auditors, from the external auditors, and looking at best practice across the sector. Obviously, a key one is financial reporting. Ultimately, it's the board's responsibility to ensure that the financial statements are correct. And that can be quite daunting, particularly if the skill base isn't heavily centred around finance. And then oversight of the senior leadership team, there's quite a fine line between being too hands-on and delegating that responsibility down and taking a far more governance role in that. Okay, so I think we're doing okay for time. I'm going to touch upon some tax considerations now. And I don't sit here and pretend to be the tax and VAT guru. We do have a very specialist team here at MC of tax and VAT partners and advisors. So I will do my best to answer any questions on the next few slides, but I may get back to you as well. And if you do have any detailed questions around this, or would like a review of adherence to and compliance, then please do let me know. I think from a tax point of view, obviously a lot of the clients that we work with do have charitable exemption to tax, and obviously that centres a lot around the purpose of charitable company and ensuring that the trade that is being carried out has the primary purpose of being charitable. And I've just touched upon here some examples of non-charitable income and the exemptions to that. So if it's less than £5,000, not overly concerned. If you're getting over that £5,000 of non-charitable income, then whichever's the lesser of £50,000 or 25% of the charitable company's incoming resources may mean that your charitable exemption is under question. So always worth an annual review of non-charitable activities to make sure that you are still compliant with those exemptions. Another point just to make here is around non-charitable expenditure. I think from a non-charitable expenditure point of view, if you are making, for example, a loan for non-charitable purposes, then that loan effectively becomes taxable income. Or if you are developing properties for non-charitable purposes, again, that would be deemed taxable. So again, annual review of that would just mean that you are ensuring compliance. A couple of other considerations from a tax point of view, obviously with shared ownership, and that seems firmly on the levelling up agenda, so we'll probably see this become more prominent over the next few years. We need special consideration around that side of things. Assessing the charitable need, I mean, ultimately it should be done on a property by property basis to ensure that charitable exemption is being met. Depend on the lettings policy and ensuring that that is also compliant, and looking at other income and making sure that that's within the thresholds, and if there's any sort of ambiguity around what the purpose of that other income is, discussing it with the experts. A few points just to highlight from a VAT perspective. We do appreciate that it is quite a significant cost and burden due to the nature of the VATable supplies that you're creating. Some examples there of exempt, taxable, unexempt, and it is quite a minefield dependent on what you are looking at. So for example, commercial could be taxable or event, refurbishment of stock from local authorities, back office services to other housing associations. I think from a VAT recovery point of view, there are steps that can be taken to enhance and mitigate losses on some of those fronts, and to make sure that strategically you are making the most of your VAT recovery. As I mentioned here, VAT can only be reclaimed to the extent that it relates to taxable supplies, and in a lot of cases the partial exemption calculations need to be undertaken, which is quite a challenging calculation. You can obviously apply for special measures, which again our VAT partner has been working with some of our clients in relation to. Few other VAT considerations and potential ways to reduce the irrecoverable VAT. Joint contracts of employment, this has come up recently, where you can recharge costs between entities without there being any VAT implications if there is a joint contract of employment. The cost sharing exemption, so this is where two or more organisations with exempt or sort of non-business trade can join together to take benefit of that exemption. VAT grouping, where a group of related companies come together almost as one to try and maximise the recovery of VAT there. Qualifying conversions, so this is sort of being a bit more strategic in the types of developments you're looking at. So it's where commercial property can be transferred to residential property, and that actually is zero rated, and any costs in relation to that would then be able to be recouped. And I think ensuring that you are aware of the option to tax before acquiring any properties, and making sure you know from the outset whether there is or isn't an option to tax will help with the VAT planning on that front. So what do we expect to see sort of as we go forward from a tax perspective? The residential property developer tax probably is not as prevalent as we thought it may have been a few years ago. The build to rent development activities have been, disclosed as outside the scope, and also fully exempt charitable entities are outside of the scope of it as well. So probably not as significant as we thought it would have been. Stamp duty land tax, as probably aware, there is a general charitable exemption, but that's based on the fact that the land needs to be used for charitable purposes. And if the land is then not used for charitable purposes, the exemption is disapplied. From a VAT point of view, some of you will have seen over the last 12 months, the domestic reverse charge for the construction sector has come into play. I think certainly the first few months of that were interesting, with ensuring that the flow charts and specifics were followed to make sure those who were reclaiming and paying were at the appropriate stages of the chain. So one to watch if you are engaging in any construction or developments. And then, as I've touched upon on the last slide, the partial exemption considerations and the special measures. From the last budget, we are also seeing some increases in tax. So the NI increases from the 6th of April 2022, an uplift of 1.25%. We're seeing national living wage increases of 6.6%. I think this is as relevant for planning and forecasting as it is to be aware of from a payroll compliance point of view. Obviously, that can have quite an impact on staff costs overall. And from a CIS point of view, it's not applicable to charitable exempt entities, but if you haven't got that exemption, it is another thing to bear in mind that the contractor scheme is in place and does need to be abided by. So if you are working with any contractors and you're unsure around growth status or whether you need to be CIS registered, then please do get in touch. I think the key thing from sort of Mitchell Charlesworth's point of view is our clients ensuring from a tax governance point of view that they are mindful of new activities or housing schemes being reviewed on an annual basis. If there is potentially non-charitable activity, should that be structured into a subsidiary? And making sure that annual review of schemes is completed to ensure compliance with charitable trading, for example, as I've mentioned here, the shared ownership structure. So just before I sort of finish off and open up to any questions, just a few things sort of on the horizon. Don't plan to go into much detail because they are quite early on in process. But obviously we've got the environmental, social and governance considerations coming into play, and social housing is playing a huge role to become socially responsible, and it's going to be a big onus on landlords across the UK to ensure compliance with that. The idea of net zero, I know there's quite a lot going on in the sector at the moment to say that to achieve that there's going to need to be additional funding because the cost is just far too great to absorb that into current income streams. We've got the levelling up agenda, which is going to obviously be quite a shake-up for the whole economy, but particularly housing, with the idea of shared ownership, idea of the ability to buy, potentially having an impact on future strategy. From a financial reporting point of view, we have got FRS 102 review probably later this year. We're not expecting too much shake-up on that front, but we will wait for the consultation on that, but whatever is updated wouldn't have an effective date until the 1st of January 2024. Sorry. I've put a link on the slides which will be circulated to key dates and reporting requirements, just as a reminder of the sort of key calendar over the next 12 months. So that was everything I thought I'd cover. I know that seems like quite a whistle-stop tour of quite a lot of changes. I'd be more than happy to take any questions now, or alternatively, if you'd prefer to go into something in a bit more detail, please feel free to contact me. My email address is on there. So does anyone have any questions? See if any questions are coming through. Okay, so we've got one come through, and that is, there's a lot to consider in writing the board report. Any advice? How long have we got? I think the concept here is, obviously there's certain criteria, certain content that we have to have in there. A lot of clients tend to roll forward last year's and update the figures. I think sometimes, whilst that may be the easier option, the idea of starting with a blank piece of paper and telling this year's story can enhance the quality of the report. But that's not to say, obviously the value for money metrics, the reporting, the benchmarking, etc. Quite a lot of it is predetermined anyway. Seeing if there's any more questions to come through. No, okay. There's no questions, so we'll end it there. As I said, if you do have any questions or want to chat through anything that's on today's webinar, related or unrelated, please feel free to get in touch. And I look forward to seeing you all soon.